This week on Moving Markets, Bursa Malaysia closes off a stellar year thanks to buoyant trading volumes. Inspired by the GameStop short squeeze, Malaysian retail investors formed their own group, Bursa Bets. Now that GameStop's share price has plunged, though, is it game over for Robinhood retail traders? And Amazon emerges as a clear winner in the COVID-19 pandemic. Since the onset of COVID-19, global equity markets have seen a sharp uptick in daily volumes. This helped Bursa Malaysia achieve a 100% increase in net profit for 2020 compared to the previous year. In fact, this set of results was the best on record since the company first went public in 2005. The Bursa's stellar performance was driven by higher trading activity. Because if there's one thing markets do not like, it's uncertainty. And COVID-19 brought a lot of uncertainty, which caused volatility. Plus, retail investors' participation was at a record high last year. Over 400,000 new central depository accounts were opened in 2020. That's more than twice the number in 2019. And this trend is largely expected to continue this year, with strong trading volumes in January, as markets remain uncertain despite vaccine optimism. Earlier this week, a group of Malaysian retail investors calling themselves Bursa Bets tried to push up glove stock prices, despite selling by institutional investors who had also shorted the stock. It seems Bursa Bets took inspiration from the Wall Street Bets retail traders who coordinated on Reddit to send shares of video game retailer GameStop skyrocketing last month, causing some staggering losses among several hedge funds. Bursa Bets, however, did not manage such a spectacular short squeeze, since short selling is much more regulated in Malaysia. But we are seeing a similar trend of day traders using social media to their advantage. And overall, it signifies a shift towards the democratization of markets, which has been accelerated by the introduction of commission-free trading on apps like Robinhood. For institutional investors, the onslaught of retailers and use of social media represents a new kind of portfolio risk that they'll have to keep an eye on moving forward. Meanwhile, shares of GameStop have now plunged about 70% on a one-week basis. It's currently trading at about $50, a far cry from its peak share price of $483. But it's not just GameStop. We also saw similar patterns in the stock prices of BlackBerry and AMC Entertainment, the world's largest theater chain. The retail trader's next target was silver, although these prices have since fallen too. GameStop's sharp price plunge indicates that the hedge funds which had bet against it have now closed out their positions. And as for silver, it's a more difficult market to corner since there are many more market participants. Does that mean it's game over for the retail investors? With these few stocks, maybe. But they are likely going to look for other arbitrage opportunities, and we'll just have to wait and see to find out who's next. Amazon is a clear winner in this pandemic era. The company reported its best quarterly earnings yet, with revenues surpassing $100 billion for the first time. But e-commerce demand is not the only factor driving Amazon's strong results. The company's profit engine is actually its cloud computing business, Amazon Web Services. This division saw its revenue grow 28% in the last quarter, making up about 11% of total sales. These strong results were, however, overshadowed by the revelation that its founder, Jeff Bezos, would be stepping down as CEO of the company later this year. He will be replaced by a man named Andy Jassy, who currently runs Amazon's cloud business, a sign that this segment will play a big role in the company's future. Amazon's share price did not move much after the announcement, indicating that investors anticipate continuity in Jassy's leadership. But while he is an Amazon veteran and a trusted lieutenant to Bezos, it's clear he has big shoes to fill. And that's what's been moving markets.